So I believe you can see the screen.
Yes, sir.
Yeah, so
Yes, please.
we went through this the last time we met break-even analysis using the equation method. We went through the break-even analysis using the graphical method, and I believe for now we can all draw break-even charts on a graph sheet nicely when the question comes. So we also went through the cost volume profit analysis using the equation approach. And the equation approach, we are saying we just go through the small mathematics, which we say that the sales revenue is equals to variable cost plus fixed cost plus profits. And we all know that sales revenue is equals to selling price times unit sold. And then variable cost is also variable cost per unit times the unit sold. Fixed cost is always fixed at the in total for the activity and the consideration, and then if there's profit. Therefore, at the break-even point, we are saying that there's no profit. So if there's no profit at the break-even point, then it means that our sales revenue is supposed to be equal to our variable cost and fixed costs. Now we know that the sales revenue is the selling price times the unit sold, and then the variable cost is the variable cost per unit times the unit sold plus the fixed cost. And so to be able to determine the quantity that we sell to make sure that the total sales revenue equals the total revenue, we have to group the like terms. So the selling price times the quantity minus the variable cost per unit times the quantity supposed to give you the fixed cost. And therefore, because we want to get the quantity as the subject of the equation, we factor the quantity out into bracket selling price minus variable cost. So quantity into bracket selling price times the variable cost supposed to be equal to your fixed cost. And because we want to get the quantity, we have to divide both sides by the selling price minus variable cost per unit. And so the quantity at the break-even point will be equal to fixed cost divided by selling price minus variable cost, where we said that the selling price minus variable cost is referred to as the contribution per unit. And so that was how we arrived at the break-even point in unit formula. Then after that, you can just develop other formulas to determine break-even point in sales value, where you multiply the same formula, fixed cost over contribution per unit times the selling price, or you multiply the quantity at the break-even point times the selling price, or you divide the fixed cost by the contribution margin ratio or contribution sales ratio. And we say contribution sales ratio is simply the contribution per unit over selling price or total contribution over sales revenue, and that gives you a fraction. When you divide the fixed cost by that ratio, it also gives you the break-even sales value. Then we came to where you want to now make a target profit. Remember that I make reference to the marginal costing approach that you are aware of, that you did in the accounting cost and management accounting 1, where in preparing profit statement and the marginal costing approach, we subtract the variable costs, all variable cost from the sales revenue to get the contribution, and then subtract fixed costs from the contribution to get profit. And therefore, you are saying that at the break-even point, contribution should cover only profit, because if there's no profit, it means that after you have taken variable costs from the sales revenue, you take the fixed cost from the contribution and you must get no profit. But if there's going to be profit, then the contribution should be able to cover the fixed cost and the profit. Therefore, when you want to make a given target profit, and so you want to determine the quantity that if you sell, you make a given target profit, then it becomes simply the fixed cost plus the target profit divided by the contribution per unit. And so if you want to get that also in sales value, you multiply by the selling price, the same formula by the selling price, or the quantity that if you sell, you make that given target profit times the selling price, or it can be fixed cost by the target profit divided by the contribution margin ratio. And then we can also have a target profit after tax, because normally organizations' profit are tax. So therefore, if you want to make a given target profit after tax, then the tax element, the the profit element must be gross with the tax element. The target profit might be gross with the tax element, so that when you add to the fixed cost, the contribution you get should cover it. Therefore, the formula for profit, target profit after tax is equal to the unit, is equal to fixed cost plus the target profit. But you divide the target profit by the 1 minus the tax all over the contribution per unit. Okay, so if you want to get it in sale value, you multiply the same formula by selling price, or the quantity you have gotten after calculating the quantity to sell in order to make a given target profit after tax times the selling price, or it can be fixed cost over the target profit divided by the 1 minus the tax element divided by contribution margin ratio, and that will also give you the same formula. So these are the 3 major formulas we develop from the break-even analysis. And after that, we also say break-even analysis is used to make some sensitivity analysis. So this sensitivity analysis is when you are asking what if situation. Remember that we have already said that there are certain assumptions that has been made before this analysis can be done. And among this assumption is that fixed costs will remain constant, that variable cost per unit is constant. However, total variable cost will vary as production varies. Okay, we also said that selling price is constant. So these conditions that we have, assumed to be constant. What if there's a change in them? What will be the break-even point, or what will be the new quantity that if you sell, you make a given target profit? So when such information is given, you only update your records. The sales, you now have to calculate the new contribution per unit. If there's a new selling price, if there's a new fixed cost, you put them into the equation, and then you follow the same formulas. So that is what we did with regard to this. And so these are what is here. You have to go through discuss all this one here. So that is unit 3. So we are going to look at the unit section 4 of unit 2 and section 4 of unit. Yes, please.
Sir, please, the examples, the questions examples in the slides.
Yes.
The question.
No,
3.
in the book. Oh, this is the book, not a slide.
Okay, the book. The question
Okay.
3. There's this thing. If you can go there.
Self-assessment question 3. Let me go there.
Yes.
Have you seen it? This
yes,
one.
Sir. Yes,
Good.
sir. Sir, you see that per the question, you have been given the variable cost and contribution.
Yes.
But before you can get the contribution per unit, is the price minus the P minus the V.
Can't you get the price, my sister? If you have the unit sold for 40,000.
Okay.
And then the sales revenue is 400,000. What is the selling price?
Okay.
What? Please tell me what the selling price. What's the selling price?
So please, I'm coming.
It's 10 cedis.
My sister, can't you see that it's 10 cedis?
It's 10 cedis. Yeah.
So what is the contribution per unit? So what is the contribution per unit?
That's what has confused me a bit. You see, my confusion came.
Okay, so what is the variable cost per unit?
The variable cost per unit is 240,000.
Variable cost per unit is. How can you say variable cost per unit? Total variable cost now is 24,000.
Yes.
No, these are total. These are in cedis. So what the figures they have given here are in cedis. Have you seen that? So yes, you have been given. You have been given this is the cheapest of the question you will do. This is the cheapest of all, because contribution per unit is 160 divided by 40,000. Yes, it is. These are all total. You have been given units sold, so you can just get the unit per unit here. So the contribution per unit here is 160 divided by 40, and that's how much? 160,000 divided by 40,000 is how much?
4.
Contribution is 4. This one is variable cost per unit is 6 cedis. If you read them to into units, this is 10 cedis, this is 6 cedis, this is 4 cedis, this is how much?
Okay, thank you.
So
thank
what
you. I didn't know it that way.
Come again.
I didn't know it that way, that you are supposed to divide all of them by day.
But
I was a little bit confused.
So please, when you are taught something, you have to be able to apply. Okay, you should be very sharp to see that once the unit sold is this, then therefore these are total amount. Therefore, variable cost varies with the units. Variable cost varies with the unit. So if you have 10 cedis here, variable cost is 6 cedis. This one is 4 cedis. Okay. So that's how. So here, contribution per unit is equal to 4 cedis. Variable cost per unit is 6 cedis. The level of sales, which will enable the firm to break even, you just have to put in the formula. Fixed cost is 100 Ghana cedis here, divided by contribution per unit, which is 4 cedis. You are going to get that unit. And then the level of sales, that will earn a profit of this. You have the fixed cost of 100 plus the target profit of 120 divided by contribution, which is 4. So the most easiest of the question you can solve is this one, except this small trick. Are you with me?
Thank you, sir.
Okay, so you can solve it now.
That was the only thing that confused me on that aspect. That was the...
So what I'm asking is, you can solve it now.
Yes, sir.
With ease.
Yes, sir.
Okay, so what of the question? What of question 2 and 3? 1 and 2.
That one I was able to do it.
That one there was no problem. That's it. Okay. So next time when you see similar questions like that, then you become very smart to look at it. Okay.
Okay. Thank you, sir.
Very good. So let's move on. Any other question? Anyone with the problem, the ones he has gone through? So now let's look at the have you seen the unit 4, session 4?
Yes, sir.
We are quickly going to look at the profit volume chart. Now, we have been taught how to draw the break-even chart, traditional break-even chart on a graph sheet. But the weakness of the traditional break-even chart is that you cannot actually depict the profit or loss at various levels on the break-even chart, unless you look at the various revenue and the cost, total revenue and total cost, then you reduce the profit. So that traditional break-even chart has that particular challenge. Okay, it has that limitation, and this limitation is overcome by the profit volume chart, because we are even looking at the cost volume profit. So we are looking at how does, when you take cost from the profit, the sales, what happens to the profits, and how do we draw this on the break-even chart. So the traditional break-even chart does not permit one to depict the profit or loss on the chart. So this limitation is overcome by the profit volume chart. And so let us see what profit volume chart is about, and how can we draw this on a graph sheet. By the time we finish discussing, you should be able to draw profit volume graphic from a given data, explain the concept of profit volume graph, and then explain the limitations of cost volume profits analysis. Okay, so let's look at the profit volume graph. We explained under session 2 that the break-even analysis is also called cost volume profit analysis. The reason being that it is an analysis of how profit change analysis of how profit change as costs change in response to changes in production or sales volume. So that is why we are saying that break-even analysis is also called cost volume profit analysis, because it is just the study of the interrelationship between cost, volume, and profit. So we are looking at what happens to profit when there is changes in cost, given the selling price. If there are changes in cost, what happened to profit? So that is what we are doing. The analysis can also be shown by profit volume chart or graph. Profit volume chart or graph. And so the profit volume charts or graph exhibit the relationship between profits and sales volume. The traditional break-even charts that we did suffers from one limitation, and this limitation is that profit cannot be read directly from the chart. And this, it can only be determined by deducting the total costs reading from the total revenue reading. Okay, so the profit volume graphic overcome this problem by plotting the profit directly against the activities. So that is why sometimes if you have done traditional break-even chart and chart, you want to, look at the profit volume chart as well to see what is happening. Okay, so let me just put my computer on charge a bit so that we don't run out of. All right, so let us use the same data that we use for the traditional break-even charts to construct the profit volume charts. And here there's a bit of confusion. So listen carefully so that you can ask appropriate questions for you to understand. Coming. All right. So the question was, the budgeted output for the factory is 120,000 units. And then the fixed costs are 4 million. It was 4 million then. Now this one is, I think it's still 4 million. Just that the comma is at the wrong place. So sometimes you do these corrections. Okay. So it is 4 million, and the variable cost per unit is 50 cedis. The selling price is 100 cedis. The net profit to be earned at a particular level of sale is determined by the net profit to be earned at a particular level of sale is determined by the contribution per unit. Okay, so the fixed costs, and it is determined by the contribution per unit, the fixed costs, and of course the actual sales level. Okay, so that is what we are saying, that once you have the sales revenue, the net profit you are going to get from at any level of sales depends on the fixed costs and then the contribution per unit. So the contribution per unit, the fixed costs per unit, and of course the actual sales level that is chosen. These three factors are more clearly shown in the form of a profit volume chart that is illustrated in figure 4.1. So look at the figure 4.1 here. This is the contribution, and this is the fixed cost line. Have you seen the fixed cost? The fixed cost, no, the fixed cost is here. The fixed cost is here. So as you produce, the fixed cost is down here because at output 0, the total fixed cost is the loss. So that's why for the profit volume chart, we use, for the vertical axis, we use both the negative and positive sides. You see, so here is a loss, then above here is profit. Okay, so the down here is a loss, above here is profit. So you can see that the total sales line is at the origin, as we know already from the traditional break-even chart. But we look at the maximum fixed cost, and that becomes the highest. So when activity is zero, fixed cost is the maximum loss, and we start producing. Fixed cost reduce the loss reduces, and at the point when we are broken even, the profit begins to emerge. So this is, for example, in this question, example that they have shown us, the fixed cost is 600, then the profit is also 600. These are the activity level. So we have the 50, 100, 120, 150, 180. This is the break-even point, the point where the fixed cost is what do you call it? Loss. We have broken where we have made no profit nor loss, because this is the loss zone, this is the profit zone. So at the origin zero, no loss, no profit is made. That's the point where we break even, and after that point, the profit will emerge. So this is how we get the what do you call it? So what you do is that you get the after the maximum loss, that is the fixed cost. But as the maximum profit, you look at the total sales from the total revenue, the total cost from the total revenue to get the maximum sales. Then you use it to plot here. Then you can just pick a point from the fixed cost when output we have not produced at all. When we have not produced, the total cost is fixed cost here. Then as we produce the what do you call it? The contribution, because the contribution will be at the break-even point, the contribution covers the fixed cost and then profit. So that is how this is done. Let's look at how the step-by-step process of undertaking the profit volume chart. Now, the profit volume chart is a simpler presentation of the facts illustrated in the break-even chart. It is prepared by first plotting the fixed costs below the break-even line. It is prepared by first plotting the fixed costs below the break-even line at nil sales. So break-even line at nil sales is this. So this is the fixed cost. So fixed cost is the maximum cost when output is zero. So that is the maximum loss. So you put that one there. Then also, so and below and reducing the loss by contribution per unit. So this is the maximum loss. So now as the contribution per unit is obtained, you reduce the maximum loss up to the maximum contribution to cover the profit. All right, so let us see the step. First step is to draw the horizontal and vertical axis. Now, step 2. So the horizontal axis here is the output or the unit sold. Then the vertical axis this time round is going to cover both the negative and the positive side of the vertical axis. Okay, so the step 2 is the negative range of the vertical axis should be equal to the fixed cost, that is the loss, and the positive side range equal to the profit, that is the total revenue less total cost. So if you draw the vertical axis, the negative aspect of the vertical axis will end at the maximum fixed cost, the fixed cost. Okay, and then to get the maximum profit, you get the total sales minus total revenue. Total sales revenue minus total cost. Total cost. Remember, the total cost is fixed cost plus variable cost. So if you take that one from the total revenue, you get the profit. That will give you the maximum profit at the sale. So you use this range. You now use that range to plot or to then scale the vertical axis. All right. Then the step 2 here, we are so in this our question, we are saying that from the example that we are talking about, fixed cost is 4 million and the profit is 4 million. That is total sales revenue of 12 million minus total cost. Now let's see what the total cost is 8,000. The total cost was more than 8,000. It was 10,000. Total cost was 10,000. It's not 8,000. So because it was it's what do you call it? 4 million plus 50 cedis times 120,000, and that was 6 million. I think so. So 6 million plus the 4 million is supposed to be 10,000 here, not 8,000. So take note of some of these corrections. Is 10,000. So it means that our profit was 2 million, not 4 million. Our profit is supposed to be 2 million. Okay. So in this case, the horizontal axis represent the sales. So the horizontal axis then will represent the sales. Remember that, look at it. The horizontal axis is the sales in units. Okay. So in this case, we have gotten the step 3, we draw the horizontal axis. So we now draw the step 4. The break-even point is determined by joining the profit line to the fixed cost line. The profit line to the fixed cost line intersect, that is the fixed cost line intersect the sales line in the break-even points. So here, more or less, this is the total the sales line. So we look at I think there's a problem here. This thing supposed to be total fixed cost is here. So at the break-even point, we start from, so we are looking at 10,000, 20,000, 40,000, 60,000, 80,000 to 100,000, and then 120,000 sales. So you look at output 0, the total loss supposed to have been 4 million. This is just an addition for the scaling. So the total cost supposed to have been 4 million. Now, as we produce, so we start from here and look at the maximum sales profit. Profit supposed to be at 2,000 here. So 2,000 here, profit. So you look at the maximum profit here to the maximum loss, and then you get a point at the maximum profit. So you trace a point here to the maximum profit, which is that 120. Okay, so that's it here, 120 here. Okay, so you put a point there, and then this supposed to have also been the 4,000 here. So straight to the 4,000 here, you definitely get a break-even point of 8,000. So it tells you that the break-even point is the point where there's no profit nor loss, and therefore at output 0, fixed cost is the total loss. When you produce to, let's say, 20,000, fixed cost will move to loss will move to, let's say, 30,000, 4 million. Okay, because this one, if it's in million, then if it's in million, so supposed to have been 4. Because if it's in million, it means that it's 2 million, 4 million. So this supposed to have been this. And then this supposed to have been this. Because we are talking of millions. Millions, then this supposed to have been 2,000. This also has been supposed to be 4,000. But these are in millions. And our question, we have in millions. Okay, so this is supposed to have been the point. So at the output 0, our total loss will have been fixed cost, total fixed cost here. But as we produce, it will reduce. It will reduce until we break even, where there's no profit nor loss, and then our maximum profit will have been 2 million. Okay, so that's how you draw it. So if you use the graph sheet, it becomes very simple to do. To do is that you look at the maximum loss is the fixed cost. Maximum profit is the total sales less total fixed cost. So you get the maximum. So you trace the maximum profit and then maximum loss, and then you put a straight line. You get the various profit at the profit at the various level, profit or loss at various level. All right. So that is the cost volume profit analysis. If there's any question, you can ask. Now, let us also look at another example of how the profit volume is drawn. So the following information relates to the production of product in units. So we have 100, 1,000, 2,000, 3,000. So these are, so total sales is 5,000, but it's divided into 5. So it means the scaling becomes very simple for you. Then sales revenue is also 800,000, 160,000, 240,000, 420,000, and 400,000. Okay. Sales per unit is, so selling price is 80 cedis. 80 cedis. Then variable cost per unit is 40 cedis. So our variable cost is this total giving us, and our fixed costs are the following giving us 90,000. So we now plot the fixed cost. The fixed cost, we can start with 100,000 because we have 90. So we can start with 900,000. But the fixed cost, the maximum fixed cost, maximum loss is 90. Okay. And then you look at the profits. These are the sales in thousands. So you look at the total profit, for the, so you get at any point at the maximum sales, let's get the total cost. That is 200 plus 90,000. That is 290,000. 290,000 minus 290,000 minus or take the 290,000 from the 400,000. 400,000 minus 290,000. And that gives us 110. So profit is 110. So of course it is between somewhere here. Have you seen the profit is somewhere here? 110. Okay. So you plot the 90,000 here, and then the 110. You can this one had just gone up, but you can just get, let's say, 120. Okay. 100,000 as the maximum loss, then 120 as the maximum profit. Just divide them into 5, so that when you start with a 90, you get to the maximum profit. Then you strike your line. You get the break-even point to be the point where there's no profit nor loss. And so that is how cost volume profit analysis is done. So the 2 points is very important. The fixed cost you get, and then the maximum profit. How do you get maximum profit? It is line, and you get the break-even point. Break-even point will be the point where the profit line contribution. This is the contribution, of course, is the contribution line that crosses the horizontal axis, horizontal line that depicts this, the output. Okay, so where they will break even, you can see that at that point, loss, a profit or loss is 0, and that is all. So that is how profit this is done. So at the 0 levels of output, the loss is 90 from this question. The loss is 90. At the 0 level of production, the fixed cost will have to be paid. That is the maximum loss. Remember, fixed cost is sunk cost, and this represents the total loss. Represent the loss at 10,000 at 1,000 units output. at 1,000 units output, the loss is now reduced to 50. So that's how it will be done. Okay. And then that is so you can just look at it. It is at 1,000 units. We have the sales revenue to be 100. Okay. Sales revenue is 80,000 or 800,000. No, 80,000. And then fixed cost and variable cost becomes one. This price is 130. So the maximum loss will be 50. So you can just get the losses and then profit at various level, and also profits. That could also be done easily. Okay. So at this level, remember that the profit is sales minus the total cost, and total cost here is 130. So we have the loss of 50, but the maximum loss, that one is 90,000. Then you come to activity 2,000 here. The total cost will be 170. 170. Have you seen? This is 170. So 170 you have this. So the loss now reduces to 10. It reduces to 10, and the 10 is somewhere inside here. 10 is somewhere inside here. When you are here, the 10 is somewhere inside. So you have not broken even. But at activity level, 3,000. Now the profit now moves. This is 140,000. Total cost now becomes that is 210. So we have a profit of 30,000. So at output 3,000, the profit is 30,000. So it tells you clearly that the quantity to break even is more than 2,000 by between 3,000, and that is exactly here. But if you do proper plotting on the graph, you get the exact point where you have to break even, that there will be no profit nor loss. Okay, so you can just look at the profit at various level of activities and then also use it to plot. But the best thing is just get the last extreme 2 points, the total fixed cost, and then the maximum, the total loss, which is the fixed cost, and the maximum profit, which is the total sales minus the total fixed cost, the total cost, and that will you plot it and you can get it easily, right? So that is how the cost volume profit analysis is done. Remember also that at 5,000 units output, the profit is 110. That is sales minus that. We have done that. So remember that the profit equation as profit is equal to sales less variable cost plus fixed cost. You know this formula already. So let us look at the limitation of cost volume profit analysis. Now, if you look at the assumptions we went through regarding or underlying the operation of the cost volume profit analysis, you could see clearly that those assumptions are not something we can really or in practical terms achieve. To say that cost should always be divided into fixed and variable, knowing very well that sometimes costs are mixed. And to also say that the only factor affecting cost and revenue is volume, knowing very well that apart from volume of output or demand quantities, sales or the sales revenue is affected by so many factors as well as the costs we incur. Okay, so and I'm also saying that the method of production, technology, efficiency with which we are producing are all supposed to remain constant. These are, of course, some assumptions that in real situations cannot be achieved. Therefore, if these assumptions are not achieved, what happens to the analysis? So this assumption becomes the limitation of the break-even analysis. So we are saying that the break-even chart and profit volume analysis. Assume that simple straight line can be drawn on the graph to represent sales revenue and costs at various levels of activity. While the basic concept is quite valid, one must recognize that there are weaknesses in presenting the information in this form, and the break-even chart needs to be qualified by the following considerations. So you see, the assumptions we make coming out with our break-even chart is that we can easily get sales line, fixed cost line, total cost line being linear. But this is very simple in theoretically, but in practice, we see that this cannot be valid. So therefore, when we are making those analysis, we consider these factors. One is that the chart is only true for a single product or a certain mix of products. A change in mix may significantly change the result. So of course, we remember that one of the assumptions under break-even chart is that the analysis is done for a single product or a constant product mix. But where in normal sales, we do not sell constant product, the product mix may not be constant, because in actual sales, the mix with which the sales are made changes. Okay, and so when the mix changes, it means that there's going to be problem with analysis. Also, selling price are not constant at all levels of sales, and high level of sales may only be obtained by offering substantial discounts depending on the cost or on the degree of competition or experiences. So we are saying that selling price might not always be, selling price cannot be constant. Sometimes firms may give discounts, okay, by reducing their price just to ensure high level of sales if there is competition. Sometimes we may charge a higher price depending on the fact that there are shortage, and therefore we do not have enough, and we are monopolizing the sales. So all this dynamism may not necessarily make the selling price constant. Also, variable cost per unit will, in practice, fluctuate, because in the assumption we are saying that variable costs must vary in total proportionally. Because if you are saying it should vary proportional with the levels of activity, it means that the variable cost per unit should be constant. However, in practice, variable costs cannot be constant. It cannot be constant in practice. It may fluctuate according to A, the extent to which quantity discount can be obtained, or larger purchases of material, or B, overtime premiums to be paid to employees, and C, general operating efficiency at various levels. So you see, the variable costs we are incurring can change given many situations. Example of what we have been giving here, that the extent to which the quantities discount can be obtained. If we buy in larger quantities, variable cost of material, but variable costs are made of material and labor, and so variable cost of material can change when we have actually bought in larger quantity and we have received discount. So the price can change. Of course, labor rate can also change depending on the overtime premium for employees, which will pay higher than the normal rate, and also efficiency with which employees are producing. This can affect the variable cost of production, which may not be able to be constant. Also, fixed costs are fixed only in respect of a given capacity, and fixed cost has its own capacity. Have you seen? So fixed costs can only it can only remain fixed for a given level of activity. At certain level of activity, fixed costs can change. So we cannot say that over the activity, the fixed cost should remain constant, because if the organization has expanded to a level, has stretched its capacity, they can now acquire a higher capacity, which will then increase fixed costs. So fixed costs cannot always be constant. Also, we are saying that the chart, the break-even chart is only true at certain small steps in levels of activity, and it is important to know whether an increase or decrease is being shown. When a business suffers a decline in sales, it is likely to reduce its production employees in direct proportion to the reduction in activity. To do so would cause grave employee problems. It is only when it appears that the business has no hope in the short or medium term. In the short or medium term of recovering the loss, that it will lay off employees. The same will apply to fixed costs. Okay, they will not be incurred immediately if the business has considerable unutilized capacity. So fixed costs can not remain fixed at one particular point in time, and so but the decision to reduce it may and phone as from the kasa here overcut. They will not incur immediately if the business has considerable unutilized capacity, but the decision to reduce it may be delayed until there is a clear no prospect of obtaining extra business. So those are the assumptions, the limitations of break-even analysis. Let's look at the self-assessment question here. Look at the question. The following data has been obtained from ADIPA. Planned output is 4,000. Selling price per unit is 250. Direct material price, direct material per unit is 100 cedis. Direct variable cost per unit is 50 cedis, and variable overhead is 25. Fixed cost is 180,000. You are required to draw a profit volume chart and to indicate the break-even points, the costs, the profits. That means the total loss, the loss, that is the total fixed cost, the cost here, and then the loss. Okay, so, and the profit. So you are looking at the total loss and the total profits. I think it's supposed to be the loss. Right. So in this question, all that you do is that get the variable cost per unit. What makes up the variable cost per unit in this question? Please, let me get your answer. What will be the variable cost per unit from this question? Please, are you with me?
Yes, sir.
Yes, so Ima. Manuel.
Sir.
What will be the variable cost for this question?
I'm calculating.
Hurry up. This time I will be calling your names to answer questions, eh? I know you are keeping long. This one.
Sir, 4.
4 what? 4 what? 4 cedis.
Sir, 4 per unit.
You mean 4 cedis?
Yes, I'm coming. Say 100 per unit.
100 cedis.
Yeah.
Variable cost per unit is 100 cedis. Are you
Yes, sir.
sure? Okay. Gifty, are you there? Gifty. Afiba.
Sir,
Yeah, so what should be the variable cost per unit in this question?
it's four cities.
4 cities. About how do
Yes,
you
sir.
understand? The question is that this is selling price. Look at it. Selling price per unit. Selling price per unit is how much?
250.
250. This is direct material per unit. How much?
100 cities.
Direct labor per unit. How much?
50 cities.
And then variable overheads. Variable overhead also per unit is how much?
25, 175.
What makes up variable cost? You have done
You add all of them.
accounting, what do you call it? Management accounting 1, cost and management accounting 1. And you cannot tell me when you have gone through marginal absorption costing, you cannot tell me you don't know what makes up variable cost of production. So if you don't apply the things you have learned previously, it will be difficult to understand things. Why would you tell me there is material, labor, variable overheads, and then you tell me variable cost is 4? And how did you get a 4? How did you even
That's
arrive at
170.
4? And if somebody say 100, then how did you arrive at 100? What makes that 100? What did you say? Because you cannot say direct material cost is the direct cost, the variable cost. Not at all. So please apply the concept you have learned in cost and management accounting to some of these things. Okay? Because the same thing we are continuing. Okay, so variable cost is the direct material, direct labor, variable overheads. So that is 170 Ghana cedi. That's the variable cost per unit. Face selling price is this, and then face cost is 180. Now, use this information to you are required to draw profit volume chart. And I told you in the profit volume chart we have the vertical axis making up of both the positive and negative side. The maximum of the negative is the loss, which is the total face cost, because when output is 0, face costs have been incurred. And so face cost becomes the maximum loss. Okay. Then the total profit supposed to be the selling price here times the sales quantity. And then you get the variable cost per unit times the sales quantity. You subtract, you now add the variable cost to the face cost to get the total cost. Take the total cost from the total sales revenue, you have gotten the maximum variable cost. So you, as you have laid and ruled the lines, you look at the maximum profit, maximum loss here, and then you trace the line straight. And then you, if you have scaled it nicely on a graph sheet, you should get your answer easily. But if you cannot even determine what is the variable cost here, you can't even get the face cost. You can't even get the total cost. So that will become a problem. So take notes how you can go about it. The next question here is state 3 limitations of cost volume profit analysis. So just the assumptions that we'll talk about, they are the ones that become the limitation. So if you look at this one, we have seen that the single product and constant mix cannot be held. Selling price being constant cannot be held. Variable cost per unit remaining constant cannot be held. Then fixed costs cannot always be fixed. It can change, as well as the fact that the chart may not depict the real situation. So those are the answers you have to give. And then the last question says that the following data relates to the operations of ABC. You have the selling price per unit giving you 3,000, variable cost per unit 150, 1,500. Fixed cost is 6 million. Output produced was 10,000. Let me put this in here. Was 10,000. So once you, let me just save it. Okay. So from this information, this small information, you are required to draw a profit volume chart and indicate the following: the break-even quantity, the loss, and the profit. So the loss is the maximum sale. So you just have to get a line straight here. Okay. Then you get the horizontal line. The origin is where the horizontal line starts. And so the maximum sale, the maximum loss is the fixed cost. So fixed cost is 6 million. That is the maximum loss. Okay, then the maximum profit. How do you get the maximum profit? You multiply the selling price by the total units sold, and then multiply the variable cost per unit by the total units sold. Get the variable cost, add the fixed cost to it to get the total cost. Take the total cost from the total revenue. You have gotten the total profit. So you trade the total profit at where it is on the y-axis, and then you straight line to the output, the 6,000 output loss, and then you get the loss zone, the profit zone, and then the break-even point, and then you get the loss zone and profit zone. Simple. So that is how this must be done. Please, can you do them? Try your hands on it using your graph sheet, and that will help you to understand it. Now let's move on to Unit 5. Unit 5 has to do with the other application of the break-even analysis. Remember that apart from the formulas we have deduced, and then the sensitivity analysis that we have gone through, and then the chart, we can also use the selling price, the break-even to determine selling price. We can use that one to determine profit. So there are certain other applications. Then we also have margin of safety. I've explained the margin of safety to you sometime. So let's see how we can use the break-even analysis to also, determine some other the other information. So by the time we finish going through the session, you should be able to determine the selling price for a product. You must be able to compute and interpret the margin of safety. Okay, so take notes. We outlined a number of uses of break-even analysis under Session 1. So please jot those uses of break-even analysis we discussed in Session 1. Take note of them. I'm not going to go back, but if I should ask from you, what are some of the uses of break-even analysis? You are students. I'm sure we have gone through, you are learning them. What are some of the uses of break-even analysis? I am calling names so that you can answer me. Okay. Okay, so Andrew JC, are you here? Hello, Andrew JC, are you here?
Yes, sir.
Yeah, so just give me one uses of break-even analysis.
Okay, so it helped to determine the cost of product.
It helps to determine the cost of the product.
Yes, dog.
Is that what we stated in the analysis? This thing we gave. Fine. So the break-even analysis can help determine the cost of a product, or the cost at various level of activity. You can determine the cost, the total cost at various level of activity. Fine. Any other? Let me ask. Gifty, you are not still there. Gifty, you are my daughter. I want to know whether you come for my classes, but you will not respond. Last time I called, you didn't respond. Hello, Gifty.
Sir, I'm here.
Why have you not been responding to my calls? You want to hide from me?
So forgive me.
Because
Like I'm
all
doing,
you have not been attending lectures.
like I've been attending lectures, but I have to attend to the kids too. So forgive me.
Hey,
Two steps
hey.
at a time.
So just give me one uses of break-even analysis. For you, I have taught you this long time ago. I mean that's why you want to dodge me, so that you have forgotten them. Hello,
So you go around and come.
I should go around and come.
Yes.
Okay, I've been. All right, so please, you not help yourself when you do not learn some of these things. Your course, the period we are teaching you is block, and so if you do not take time to go through some of these things, you will finish is an issue. You can't do them. Please, there are things we have gone through, and take your time to understand them. Please go through to understand them well. Okay, we said it can be used to determine the break-even point, the point where there's no profit nor loss. It can be used to determine the selling price. It can be used to know the quantity, the profit, the quantity to sell in order to make a given target profit. It can be used so many uses of the break-even analysis we talked about. Please go through in session 1. Okay, so you should be able to understand. So outline those number of uses that we have. So in this session, we want to explain how to fix selling price and compute the margin of safety. We are told that break-even analysis can be used to determine the selling price or to even determine the prices at different market differentiation. So fixing selling price using the break-even analysis. Let us see a question here. Abotal Limited wishes to sell 14,000 units of 8 products. 14,000 units of 8 products, which has a variable cost of 15 cedis. Variable cost of 15 cedis to make and sell. Fixed costs are 47,000, and the required profit the company wants to make is 23,000. So how do you determine the fixed cost? How do you determine the selling price? Remember that sales revenue supposed to be equal to fixed cost plus profit. If there's no sales revenue supposed to be equal to fixed cost plus profit. Okay, if there's no what do you call it, profit, or if there's profit, contribution supposed to be equal to fixed cost plus profit. If you are making profit, contribution is equal to fixed cost plus profit. Therefore, to get the contribution, we have fixed cost plus profit here. Fixed cost plus profit. Okay, so this is contribution. Now, expected unit of sale is 14,000, and variable cost per unit is 15. And remember that we subtract sales, we subtract variable cost from the sales to get contribution. Therefore, if you have the contribution in total, when you add it to the variable cost, it should give you the sales revenue. Therefore, the expected output of sales is 14,000. Therefore, where our expected contribution per unit will be the 70,000 here divided by 14, and therefore our contribution per unit is 5. If our variable cost per unit is 15, then our contribution per unit added to the first variable cost per unit should give us the selling price. Better still, you can just look at the total sales by multiplying getting the variable cost. The variable cost here is the 15,000 multiplied by 15,000 multiplied by It's 15. That is 14,000 times 15. That gives you 14,000 times 15. It gives you 21,000. 21,000 plus your contribution of 70,000 gives you 180,000. Now, 180,000 divided by the total units sold should give you the selling price. Should give the selling price. So the selling price is 20. So two ways of getting it, because we know that sales revenue is equal to variable costs plus fixed costs plus profit. So if this is if the profit is, what do you call it, 123, and then the fixed cost is 47, then our contribution becomes 70. Now our variable cost per unit is 15. So 15 times the 14,000 will give us total variable cost. When we add the total variable cost to our contribution, it should give us our sales revenue. Therefore, the sales revenue now divided by the unit sold should give us selling price. Better still, you can get the contribution per unit plus the variable cost per unit. That is also equal to selling price. Okay, because contribution per unit plus variable cost per unit gives you selling price. Right. So that is it. So two way of doing it. You can use the unit approach, you can use the total approach. But unit approach, just get the variable cost per unit, get the contribution per unit. How do you get the contribution per unit? It is a fixed cost plus the profit. Fixed cost by the profit gives you the total contribution. Divide by the unit sold, you get the contribution per unit. Then you add the contribution per unit, the selling price per unit, you get the selling to the variable cost per unit, then you get the selling price. If you want to use the total approach, very simple. Just get the total contribution, then get the total variable cost. Add the two. It's supposed to be equal to your selling price, the sales revenue. So therefore, if you divide that by the total unit, you get a selling price. Then you come to the margin of safety. Margin of safety here, it shows the measure by which total sales exceed the break-even points. Okay, remember that I've made mention of this margin of safety when we're talking about the break-even chart. So we said the margin of safety is the difference between the break-even point in units and maximum sales units, or break-even point in value and the maximum sales value. Okay, so the definition of margin of safety is that it measures the extent to which the break-even point will fall before maximum sales will be reached, or it actually measures the extent to which actual sales or the budgeted sales will fall before break-even point will be reached. So we're saying that it shows the measure by which total sales exceed the break-even point. So margin of safety is a measure by which the budgeted volume of sales is compared with the volume of sales required to break even. So it is a difference in units between the budgeted sales volume and the break-even point. It can also be expressed as a percentage of the budgeted sales. So we can also get the break-even point in percentage. Break-even point in percentage is the difference, the break-even, the margin of safety expressed as a percentage on the budgeted sales. So if you subtract the budgeted sales, a break-even from the budgeted sales, you get the margin of safety. And if you express this margin of safety as a percentage on the budgeted sales, you get the margin of safety in percentage. So now let's look at the question here. The question here. Mami Enterprise makes and sells a product which has a variable cost of 30 cedis and which sells for 40 cedis. Budgeted fixed costs are 70 Ghana cedis and budgeted sales are 8,000 units. What is the break-even point and the margin of safety? So in this question, what is the break-even point? Face cost is 70 Ghana cedis, and the break-even point is face cost over contribution per unit. How do we get a contribution per unit? Contribution per unit is selling price and there's a variable cost per unit. In this case, selling price is 40 Ghana cedis, contribution per unit is 30 Ghana cedis. Therefore, the variable cost is 30 Ghana cedis. Therefore, our contribution per unit is 10 cedis. Therefore, our break-even point is a face cost of 70 Ghana cedis, 70,000 Ghana cedis divided by 10 Ghana cedis, and that gives us 7,000. Now, the budgeted sales in the question is 8,000. Therefore, what is the break-even? What is the margin of safety? Margin of safety in unit is the 8,000 here minus the 7,000. 8,000 minus 7,000, and that will give us 1,000. Okay. Then to get the margin of safety in percentage, the 1,000 expressed as a percentage on the 8,000, which is the budgeted sales, times 100, and that will give you. So you have this minus this, which is 1,000 divided by 8,000 times 100, and that gives you 12.5 or 12.5%. So that is how margin of safety can be calculated. You can be given an examination to determine margin of safety. So know how to calculate the margin of safety in units and in value, and then how to express margin of safety as a percentage. Note that it is the margin of safety, the difference between the budgeted sales and the break-even sales, which is the margin of safety. And if you want to get in percentage, that difference over the budgeted sales times 100. Take note, it is not on the break-even sales, but rather the budgeted sales. Sometimes in examination, students make mistakes. There was a little question some time ago for master students on this simple thing, and they were not able to do it. So please take note of it. If you have any question, you can ask. So the margin of safety indicates to management that the budgeted sales can fall short by 1,000 units or 12% before break-even point is reached. So that is what it means. We are saying that the margin of safety is the extent, or it shows the extent to which the budgeted sales will fall before break-even point will be reached. So here we are saying that it indicates to the management that the budgeted sales can fall short by 1,000 Ghana's units, 1,000 units, or 12.5% before the break-even point is reached. Now let's look at self-assessment question here. AC enterprise produces a single product, and the following data relate to a forthcoming year. You have the selling price to be 100 Ghana cedis. Material cost per unit is 40 Ghana cedis. Labor cost per unit is 20 Ghana cedis. So what will be the variable cost? What will be the variable cost per unit? What will be the variable cost per unit?
60.
Ajay? 60 cedis.
Yes, sir.
Okay, so that is 40 plus 20. Take note of this thing very well so that it doesn't confuse you. Okay, the face cost per annum is 400,000, and then budgeted output. This one is in units. It's not in Ghana cedis. The 16,000 here is in units. The question is that you are required to present the above facts on the cost volume profit graph. Calculate the margin of safety. So in this case, you have the maximum loss to be 400,000, and then the maximum profit supposed to be 100,000. The 100 cedis here times the 16,000. That will give us 1,600,000. Then you now multiply this 60 by the 16,000 here to give you the variable cost at the face cost to get the total variable total cost. Now take the total cost from the total sales revenue. You have gotten the maximum profit. So you have the two extreme, the maximum profit, the maximum loss. Then you locate the maximum profit on the maximum sales here and the maximum loss here, and then you have the middle. So the line is this. Okay, then the activity line is here. So you have the 0 here, and then you now locate the profit here, locate the loss here, you strike the line. Use the break-even chart very carefully. Use the graph very well. If you use the graph, you now be able to get the break-even point here. Now, after you have gotten the break-even point, you now know the budgeted sales. So to get the margin of safety, it is the budgeted sales less the break-even point in units. And you have gotten the margin of safety. You can express the margin of safety by, on the margin of safety as a percentage on the budgeted sales times 100 to get the margin of safety in percentage. So that's how you go about it. Right. So let us now move on to the last session of Unit 2. Then we move on to Unit 3. So the last session of Unit 2 here, we are looking at the multi-products approach, or the cost volume profit analysis and the multi-products approach, or the cost volume profit analysis for multiple products. Now, the analysis for the single product is a bit simpler, but the same idea. There's no difference here, except that when we are talking of the multi-products, the fixed cost that has been given, or the fixed cost that will be given, is the fixed cost incurred by the organization in selling all the products. So you cannot attribute the fixed cost to only one product or a single product. So the break-even point in value, or the break-even point, cannot be fixed cost less fixed cost divided by the contribution sales ratio. No, it's now become fixed cost divided by weighted average contribution margin ratio, because the fixed cost there is not related to only one product. That fixed cost is used to make the sales for all the products. Therefore, to get the contribution margin ratio, you must get the weighted average contribution margin ratio. And to be able to get the weighted average contribution margin ratio, you go through some few steps. Okay? So the steps involved in undertaking cost volume profit, the cost volume profit analysis and the multi-product are as follows. So by the time we finish discussing this section, you should be able to compute contribution margin ratio. Remember, contribution margin ratio we calculated under the single product approach is simply contribution over sales, or contribution per unit divided by the selling price. Okay, so that's the same idea. So you should be able to compute the contribution margin ratio. You should be able to compute the percentage of sales of each product in the production mix. The production mix here is the proportions with which the total sales of the firm has been made from the various products. So if the company sold 3 products, how much percentage of the sales is coming from the product A? How much percentage of it is coming from product B? How much percentage of it is coming from product C? Okay, so that is the mix with which the sales are made. And so you should be able to calculate the percentage of sales for each product, and then calculate and interpret the break-even for a firm with multi-products. Yes, so you should be able to calculate and interpret the break-even for a firm with multiple products. So let's look at the steps involved. These steps are not difficult, but you must clearly understand them. Please open your mind, refer to the previous knowledge you have learned, you have learned in the single product approach, and then bring all this knowledge from cost and marginal accounting 1 to bear so that you can understand. Then ask relevant questions so that you'll be able to, get it right from here. Because most of the times, this aspect, students do not get it. You will finish teaching, you ask them they have understood, they will say yes, sir. The examination question will come, nothing is done. They get it wrong. So don't be that part of students. Okay, take your time and then let us go through the steps one by one. The computation of the break-even points for multi-product is not as straightforward as that of a single product, because for the single product, once we have arrived at the break-even formula, we said break-even point or break-even sales can be obtained by dividing the fixed cost by contribution margin ratio. And here, contribution margin ratio for the product is just the contribution per unit divided by selling price per unit. But in the multi-product, you cannot just divide the fixed cost by the contribution margin ratio for one single product, because the product are many. That is where we are saying that the computation of break-even point for multi-product is not as straightforward as we have in a single product approach. A number of computations are then required, and all these computations are just to arrive at the weighted average contribution margin ratio, because we are not going to look at the contribution margin ratio from only one product. We have to look at the contribution margin ratio coming from all the number of products that have been sold. And so it becomes weighted average contribution. But what are we using to weight? We are just using the sales portions of each of the product to weight their contribution so that we can add them to get the weighted average contribution margin ratio. So the steps, we said a number of computations are required, and we explain the step-by-step process involved in cost volume profit analysis for a firm producing multi-product. So we are going to use some few steps to determine the weighted average contribution margin ratio so that we can then go ahead with our formula, fixed cost divided by the weighted average contribution margin ratio. So the first step here is to computation of contribution per unit for each product. So if we have 2-3 products, you have to determine contribution per unit for each of the products. Contribution can be per unit or can be in total. So contribution, what do you call it? Contribution per unit for each product, we have gone through that in the single product approach. We know for each product, if you want to determine contribution per unit, it is the selling price minus the variable cost per unit, or the sales revenue minus the total variable cost. All of them will give us a contribution for each of the products. So determine the contribution for each of the products. Okay. Then, the analysis begins with determining the contribution by each product. Remember that contribution per unit can be calculated as selling price per unit minus variable cost. You know that. It must be noted also that the contribution per unit can also be referred to as contribution margin ratio. So contribution per unit can also be referred to as contribution margin. That one is contribution margin. The use of contribution margin is particularly useful where the total sales and total variable costs are given rather than the selling price per unit and variable cost per unit. So we can also call it contribution margin instead of contribution per unit. Can call it contribution margin. The same thing, but we normally refer to as contribution margin when we have been given sales for each of the products and the variable cost for each of the product without stating the fixed cost and the selling price and the variable cost per unit. Right. So step 2 is to calculate contribution to sales ratio. Contribution sales ratio. Okay. So to calculate the contribution sales ratio for each of the products. So the next step involves calculation of contribution to sales ratio or contribution margin ratio for each product using the formula contribution per unit over selling price per unit. Right. Then the third step is the calculation of percentage to sales. So for each of the products, what portion is their sales to the total sales of the firm? So if the total sales of the company is, let's say, 10,000, and you have 30,000 3,000 coming from product A, 5,000 coming from product B, and 2,000 coming from product C, then you can just look at the proportions of sales to each of these products. Now, total sales here, I'm saying, is 10,000. So if you take product A, which is 30,000, so it will be 30,000 divided by 10,000 times 100. Okay, and that is 30%. Product B will be 50% because it will be 50 over 10,000 times 100. And it will be 5,000 times 10,000 times 100. And that of product B, C will be 20%. So that's how you determine this. So it is sales of individual products divided by the total sales of the firm times 100. Then the next competition, which is the fourth competition, is what is going to give us the weighted average contribution margin ratio. And that is what is going to be the divisor, or the divisor for the break-even formula. You know, the break-even formula is fixed cost over contribution margin ratio. But the contribution margin ratio in multi-product approach supposed to be the weighted average contribution margin ratio. And so the first three steps we go through in order to now arrive at calculating this weighted average contribution margin ratio. How do we determine that? The denominator for the formula for calculating the break-even point for multi-product is the weighted average contribution margin ratio. And how do you calculate that? It is calculated as follows. That is C1P1 plus C2P1 plus C3P1 plus CNPN. That is etc. to whatever quantity of product you have. So what do we mean by the C? So that is multiplying each product contribution. So the C is the contribution margin ratio for each product by its percentage to sales and summing them up. So the C is the contribution margin ratio for each product, which we have calculated in the second step. In the second step, we have calculated the contribution margin ratio. In the third step, we have calculated the percentage of sales for each product. So you just have to multiply the contribution margin ratio by the percentage for each product. So product A, product 1, product 2, product 3, and product N, depending on the number of products you have. You sum them, and that gives you the weighted average contribution margin ratio. Then the fifth point is where you determine the break-even points in sale value. Break-even point in sale. Remember that when we divide the fixed cost by the contribution margin ratio, it gives us the break-even sales value straight. So therefore, in multi-product approach, the break-even point in value becomes fixed cost over weighted average contribution margin ratio. And so that becomes easy to listen. So if you have reached the fifth stage, the fifth point becomes the listen. From step 1 to 5, you can just do it on the table. But step 1 to 4, you can simply do that one on a table to get the weighted average contribution margin ratio. Then you now come to step 5, where you determine the break-even sales in value, which is fixed cost over weighted average contribution margin ratio. Then step 6 is just the allocation of the break-even sales to the individual products. Because at break-even point here, we have the total sales revenue for the firm for all the 3 or whatever product you are selling. So if you want to know the break-even sales for each product, you come to step 6. That is where you allocate the break-even sales to each individual product. How do we do that? We multiply the percentage of each product sales. Okay, so we have, let's say, the example I was giving. If you have product A having 30% of the sales, product B 50%, and product C 20%, then you just multiply this percentage by the break-even sales, and you get the contribution, or you get the break-even sales for each of the products. Then point 7 is where you determine the units sold for each product. Once you have gotten point 6, where you have the sales revenue for each of the products, you can, if you have the units sold, or you have the selling price. If you have the selling price, you can divide the the sales for each product at the break-even point by the selling price for each of the product to get the break-even units or break-even point in unit for each product. So the result obtained in step 6, which is the sales revenue at break-even point for each of the products, for each of the product is divided by its selling price. So the selling price of the product in order to determine the break-even point in sales units. All right, so that 0.7.8 here is just a check. Most of the times in examination, you may not need to do 0.8 or the step 8. Or the step 8 does not actually, it's just a proof of the fact that the steps you have gone through are correct. So how do you now prove or check the results of our step-by-step analysis? The computation are checked for their correctness by multiplying each product sales in units. It is obtained or it is checked by multiplying each product sales in units by its contribution per unit. Okay, by its contribution per unit. Now, the computation can also be checked by multiplying the contribution margin ratio of each product by the break-even point for each sales. Break-even sales for each product. In either case, this should sum up to the fixed cost, of course, because once we get the contribution per unit, contribution at the break-even point to cover fixed cost. Contribution to cover fixed cost. So if you multiply the contribution per unit by the unit sold for each of the products at the break-even point, when you sum up them, it should be equal to the fixed cost. If you have the contribution margin ratio, if you multiply the contribution margin ratio by the break-even sales for each product, when you sum up, it should also give you the fixed cost. That is how you prove or you check the. So that is it. Now let us use an equation or a question to illustrate each of the steps. So in the examination question, you may just want to use table, but this is an illustration for you. At the end of the day, I will tell how you can use the table to just get the step 1 to 4. All right. So Glory Limited produces 3 products: Alpha, Beta, and Delta. The following are the results of each year. The result for 1 year. So we have the product here: Alpha, Beta, Delta. Total sales is 100,000. So we have been giving sales values. We are not giving sales in units. Some question will give you sales in units and the selling price and the variable cost per unit. So you can just easily get the contribution per unit using the unit basis. But here you have been given sales revenue. Okay, means that the selling price times the quantity sold is what I've been giving you here. And then you have the variable cost per unit, variable cost for each product. Here too is the total variable cost. Okay, so the fixed cost given for the 3 products is 22,200. The question is, let us use the question on Glory Limited to illustrate the step-by-step approach. Right. So we said that in the steps that we are going to go through, the first one is to determine the contribution margin for each product. Contribution margin for each product. So how do we get a contribution margin? We know that contribution margin or contribution per unit is equal to selling price minus variable cost per unit. But if you are not giving this the unit basis, you can also determine the contribution by deducting the variable cost from the total sales. So in this case, our contribution margin is equal to sales revenue, sales less variable cost. Okay, so this will become our contribution. And this should not be a difficult thing for you because you have done marginal costing basis. You have done marginal costing approach or preparing profit statement using marginal costing. So you know that in preparing profit statement using marginal costing, we subtract variable cost from the sales to get contribution margin. Right. So after you have gotten the first one, you now come to the calculation of contribution margin ratio. Contribution margin ratio is simply expressing the contribution over the sales. It's like we are saying it is contribution over selling price per unit, or contribution per unit over selling price per unit. But this one is contribution in total. So it is contribution divided by sales. And that will give you the contribution margin ratio. So in this question, our contribution for each product, we have 30, 12,000, 30,000, 12,000, 5,000. This one is minus, negative, because the sales was 120,000, and then variable cost was 25. So of course, so there was a negative contribution of 5,000. Don't just say that this is wrong. No. Don't just say that this is wrong. You can still calculate with it. Okay, so we have the various contribution divided by the sales revenue. And so you have the contribution. Leave them in decimals. Don't multiply by 100. So leave them in decimals. So now, if you now look at it, when you add them, you get this one. Then let us look at, note that the overall contribution margin ratio for the company can also be computed using the weighted average contribution margin ratio. You can calculate that using the weighted average contribution margin ratio, and especially that's where we are working to arrive at. Okay, so now the third step is to calculate the percentage of sales for each product. So in the product, we have the total sales being 100,000. Product alpha is 30,000, alpha is 50,000, beta is 30,000, and delta is 20,000. So for alpha, it's 50,000 divided by 100,000. That is 50% of the sales. Delta is 30 over 100. That is 30% of the sales. And then beta, and then delta is 20 over 100,000. That is 20%. So having gotten this, the fourth point is to determine is to calculate the weighted average contribution margin ratio, or compute the weighted average contribution margin ratio. How do we do that? We'll multiply the weight of the products, the three products, each of the products, by the contribution margin ratio, and then we sum them. So this is the weight for each of the products: 50, 30, 20. This is the contribution margin ratio. This one is a negative one. So you multiply that, and we get this one is 0.3, because 0.5 times 0.6, that gives you 0.3. This one gives you 0.12, and this one gives you negative 0.05. So when you add them, you get the weighted average contribution margin ratio of 0.37. So now, after you have gotten this one, that is where you come to now put it in the break-even formula. Break-even sales, break-even point in sale value is fixed cost over the weighted average contribution margin ratio. In the question, fixed cost was 22,200. Therefore, we divide that by 0.37, and the sales revenue for the company, for the firm, is 60,000. Everything is 60,000. Now, the 0.6 is where we allocate the break-even sales to each of the products, to the individual products. And so we use their percentage of sales to multiply by the break-even sales to get their various sales at the break-even point. So 30 alpha will be, the break-even point for alpha will be 30,000, because it is 8% of sales, 50,000 times the break-even sales for the company. Okay, so that's how we arrive at them. And then the seventh one is to determine the break-even units in value. So in this session, the question given us here, have you seen that in this question we don't have we don't have the selling price. We have been given the sales value. We have been given variable costs. We were not told the units that were sold to get this one, so as to determine the variable cost per unit and selling price per unit. If we have been given the units sold for each of the product, we could have gotten their selling price and their variable cost per unit. However, because we don't have the selling price per unit, because we do not have the quantity sold, we cannot determine the break-even unit for each product, because in this case we cannot divide. What we'll have done is to multiply, is to look at the break-even sales for each of the product here, divided by their selling price. But we don't have the selling price. So in this, we said that in this question, since the selling price per unit of each product were not given, it would be impossible to determine the break-even sales in units. So for the 7th, 8th point, where we are checking for the result, we said we don't have the units contribution, we don't have the unit sold, so we cannot use the unit approach, but we can multiply the contribution sales ratio for each product by their sales at the break-even point. These are the sales at the break-even point, multiplied by their sales contribution per unit. When we add them, it should give us the fixed cost of 22,200. Yes, so that is the weighted average approach, or let's say the multi-product approach. Now let's look at some self-assessment question. Let's discuss so that you'll be able to know how to go about this. So the ABC Limited has prepared a budget for the next 12 months when it intends to make and sell 4 products. And these products, details of which are shown below. So you have product JKLM. Units sold, we have 10,000, 10,000, 50,000, 20,000. Selling prices have been given, variable cost per unit have been given. The question is, the budgeted fixed costs are 240,000 per annum, and total assets employed are 570,000. The question is, you are required to calculate the total contribution earned by each product. Calculate the total contribution earned by each product and their combined total contribution. Then, to plot the data of your answer to A above in a form of a contribution to sales graph, or profit volume graph, and then to explain your graph to management, to comment on the result shown, and to state the break-even point, and to describe briefly 3 ways in which the overall contribution sales ratio could be improved. All right, so that is a very tough question. This question is not meant for degree students. Most of the times it's a question for ICA and masters. All right, because we will not take you through the multi-product chart, profit charts in this one. Okay, so this question may not necessarily come in your examination, but it is doable. Just that if we say we are going to go through it to take our time. Now let's look at question 2, but at least you know that you can follow these steps to at least get the total, to calculate the total contribution by each product and their combined totals. You can just do that. Contribution for each product and their combined totals. How do you get a contribution? Remember that the sales, to get the sales revenue, multiply the selling price by the quantity sold. The variable cost per unit You multiply the variable cost by the quantity sold. Take the variable cost per unit from the sales, you get the contribution in sales for each of the products. Now, if you total it, you have gotten the total contribution for each of the products. So it becomes simple. First of all, get the total sales. Sales is the unit sold times the selling price. Okay, you get the total of the sales. Then variable cost in total is the variable cost per unit times the unit sold. You have gotten the variable cost for each of them. Now take the variable cost total from the sales revenue. You have gotten the contribution in total for each product, and you sum them to get for the total for the combined. Okay. Then for the plotting of this on the cost volume profit line, the same idea, but here the products contribution, the contribution are combined products. So you start from product A, you have it's a combined distance. So product A, B, C, D leading up to the total contribution. Okay. Right. So you don't worry about that question. It's not under your distance. Now, Asamoah Limited plans to sell a standard office chair for 12 cedis and a deluxe office chair for 160. Asamoah purchases the standard chair for 30 cedis and then deluxe for 40. Asamoah Limited expects to sell one standard chair for every deluxe chair. The company's monthly fixed costs are this. So you are required to how many units of each type of chairs must Asamoah Limited sell and each month to break even, and how many units of each type of Asamoah Limited chairs. So you just first of all have to look at you just go through the steps. We have two products, standard chair and then deluxe office. The selling price, the quantity, the selling price for each of them has been given. Okay. Then the purchase. So the variable cost, the purchase cost is the variable cost. Sales here, the variable cost is here. And then you have that Asamoah Limited expect to sell standard chair for every deluxe chair. It's one. The Asamoah Limited expected to sell one standard chair for every deluxe chair. So it means that one expected to sell. So it means a 50-50. That the sales are 50-50 because you are expected to sell one for every deluxe. So that means the sales are in 50-50. Okay, so you can just look at the sales mix and then you can just go through the steps, get the contribution per unit for each product. Okay, and then get the contribution sales ratio for each product, get the percentage, which is 50-50, get the weighted average contribution margin ratio, then divide by fixed cost to get it. Now, how many units of each type of share might Asamoah Limited sell each month to break even? So if you now got the break-even sales, you can divide the break-even sales among the two shares and then once you have their selling price, determine the quantity that they have to sell. Then how many units of each type of Mas Asamoah Limited shares sell each month to earn this. So they said how many units of each type. So how many units of each type of Mas Asamoah Limited's share sell each month to earn this profit. So in this case, you are just going to look at the fixed cost plus the target profit divided by the weighted average contribution margin ratio. Then after that, you divide to be able to get the profit. So the same idea here. It's not a difficult thing to do. Right. So now we are done with units. We are done with the units Unit 2. Let's move to Unit 3 quickly. Because we don't have time. You have made me aware that so let me just quickly get the Unit 3. At least we can do 3 sessions today, and then we look at Friday if you can do the next 3 sessions before Saturday. Saturday I'll be teaching. I'll be invigilating at Tamale, so we'll see how we can arrange to meet. Okay, so now let me share again. So we are, have you seen, can you see the screen?
Yes, sir.
Okay, so we are starting with unit 3. After which unit are you going to use for your quiz 1? Your quiz 1 will cover how many units?
I think it depends on you.
No.
The first 3. The first 3.
Okay. Oh, but the quiz, we are not the ones. You are not the one doing it. You are doing it too. But it's online.
So,
Yes.
but you are the one setting it.
Okay, so up to unit 3. So we should be able to cover. And after this unit, you are going to do that one before we begin or what?
No, when we are done with the
Finish all.
we finish with the order.
Now we'll finish all before you start the
Yeah.
exam.
Yes.
And we will continue to write the exams.
Yes, sir.
Sorry, I see. All right. Then you know it's not easy. Then so we are going to now look at the concept of relevant cost. And in management accounting, or for managers, we need relevant information to make decisions. Management accountant is part of management, and he provides relevant cost information for decision making. So the cost that we are incurring in organization, or the revenue or whatever that we are going to, cost information that we are going to provide, we should know which of them are relevant for a given decision, so that we do not bore management with unnecessary information that may not influence their decisions. So it is important for managing accountant to clearly distinguish between relevant costs and irrelevant costs. So how would you define relevant cost? We're saying that relevant cost would be the cost that will influence management decision. If management is making a decision and a particular cost will change or will arise or it will be incurred when that decision is taken, then that will become a relevant cost. Cost that will not be influenced, that will not be incurred, that will not change as a result of whatever decision management take is irrelevant. So by way of introduction, we said a manager is sometimes faced with the problem of identifying costs which are relevant to making a particular decision. Such decisions include make or buy, make or buy, taking on a special order, adding or dropping a product line or department, and to sell a product or process further. In taking such decisions of this nature, it calls for identification of relevant costs and irrelevant costs. Okay, so we are saying that management are often faced with the problem of identifying which costs are relevant for undertaking certain short-term decisions. And some of these short-term decisions include make or buy, where management may have the option to produce a particular product in-house or buy it outside. Now, in taking such decisions, you need to be able to identify which costs are relevant, which costs are irrelevant. Management may also be faced with a situation of taking a decision to either accept or reject a special order, where a customer who is a loyal customer to the company has offered to buy certain quantities of a product at a lower price than what the company is selling. Now, company managers may be faced with this problem of either accepting or rejecting this special order. Now, whether you will accept or reject depends on your ability to differentiate between what costs are relevant to this decision and what costs are irrelevant. Okay, it can also be by either dropping a product line, because a company may be producing different product lines, but the cost information might indicate that a particular product line may not be making profits or it's not making profits. So the management might take a decision to either drop that particular product line or still keep it. Now, the decision to either drop or keep it depends on what costs are relevant and what costs are irrelevant. It could also be that the company will want to drop a particular department in the organization that is constantly making losses. But whether to close down that department or still keep that department running depends on the cost information as to which costs are relevant, which costs are irrelevant. Processing further products. So there are so many decisions that management will use relevant costs in making. And so open your mind and clearly understand what we mean by relevant costs and irrelevant costs. You have been introduced to these terms in Cost and Management Accounting 1, where you are told what relevant costs are, what irrelevant costs are, what variable costs are, and all that. But we're now going to see how this relevant cost is applied, or the application of this relevant cost in making short-term decisions. Now, by the time we finish going through this session, you should be able to define and identify relevant costs. Then also state and explain a general rule for differentiating between what a relevant costs and irrelevant costs are in making decisions. And you should be able to also state and define at least four terms which have the same meaning or which connotes relevant costs. So let's go on with it. We have, what is the definition? Hello?
Hello,
What
Doc.
is? Yes. Are you hearing me? Is there any problem?
No, sir.
Yes. So we are talking of, or we trying to find out the definition of relevant costs. So meaning and identification of relevant costs. What costs are relevant in decision making? This is a question that can be posed. What costs are relevant in decision making? The answer is very simple. Relevant costs are costs which arise as a result of carrying on particular projects or as a result of taking a particular decision. So a relevant cost is a cost that will arise or that will be incurred, that will change as a result of carrying on a particular project or as a result of taking a particular decision. So that is what we refer to as relevant cost. If a cost will arise or will be incurred, will increase or will change as a result of taking on undertaking a particular project or taking a particular decision, then that particular cost is relevant. According to the Institute of Management Accountants, Chartered Institute of Management Accountants, they define relevant costs as costs that are appropriate. Listen carefully. They define relevant costs as costs that are appropriate to aiding the making of specific management decision. So if a cost is going to aid management in making a particular specific decision, then that cost is relevant. Relevant costs are costs that will be incurred in future and can be either variable costs or variable or fixed. So relevant costs are costs that will be incurred in future. Of course, once a decision is taken and the cost will be incurred, definitely it means that the cost will be incurred in future. With this tells you clearly that when costs are past or when costs are historical, they are not relevant. Okay, and also the relevant cost could be either variable or fixed. On the other hand, if costs are not relevant to a particular decision, if costs are will not influence or will not arise or will not aid in a particular decision, the costs are referred to as irrelevant costs. So irrelevant costs are costs which do not arise, which will not be incurred, or which does not change as a result of a particular decision or undertaking a particular project. Such costs are irrelevant costs. A cost which has already been incurred or committed is an example of irrelevant cost. A cost which has already been incurred and or we have committed ourselves to it, whether we do something or not, we will have to pay it. Those are irrelevant costs. It has no effect on the decision to be made. So another example of this irrelevant cost is what we refer to as sunk costs. Sunk costs are costs that has already been incurred and cannot be recovered even if a decision is taken. Okay. So other cost terms that are the same as relevant costs, certain terms may connote or have the same meaning as relevant costs and therefore are relevant to decision making. Let us look at some of these terms. One of them is avoidable costs. So you can be asked to differentiate between avoidable costs and unavoidable costs, or let's say avoidable costs and opportunity costs. You can be asked to differentiate between those terms. So take note of them. When we say unavoidable costs, an unavoidable cost can be defined as a cost that can be eliminated. A cost that can be eliminated as a result of choosing one particular or as a result of choosing one alternative over the other. If you have a cost that you can avoid when you make a choice between two alternatives, or if you make a decision and you can avoid incurring a particular cost, then that cost is avoidable cost. And so we are saying that there are costs that can be eliminated as a result of choosing an alternative over the other or as a result of taking a particular managerial decision. They are usually identified with a particular activity or sector and can be avoided if the activity or sector is not in existence. So for example, if we decide to drop a product line and a particular cost will not be incurred, then that cost is an avoidable cost. We can avoid that cost by, not going ahead with that particular decision. So if a cost can be eliminated as a result of a particular management decision or as a result of making an alternative, a choice between two alternatives, then that cost is an avoidable cost. Opportunity cost here is also a cost that can be referred to as a relevant cost, because when we have learned economics, we know that opportunity cost is the next best alternative for gone. So once you have options and then you make a choice between the options, the alternative foregone becomes your opportunity cost. And because it is a relevant cost because you have avoided that cost in order to make a choice. So opportunity cost may be defined as the benefit cost, as a result of choosing one alternative and foregoing the next best alternative. That is making a benefit you're going to get as a result of making a choice between making a choice of one alternative, and foregoing the best alternative. It is a key factor in make or buy decision. In make or buy decision, opportunity cost is very important because we are going to make a choice between either buying the products outside or producing the product in-house. So whichever options we make, we are going to forego the other, and therefore it's an opportunity cost. Another term is what you call the differential cost. Then when we say differential cost is a difference in costs. It's a difference in cost between two alternative activities or courses of action. If we have two alternative courses of action, and then a particular cost differ between these two, that cost is a differential cost. For example, if you have option to invest in bakery or in farming and bakery, you have the option to invest in farming and bakery, and then the investment we need to invest in these two projects are the same. We don't have the amount to invest in these two projects, or they are not the same anyway. That means that maybe the cost of investing in bakery is, let's say, 25,000, and the cost of investing in farming is 20,000. Then the difference in cost of 5,000 is the differential cost. That could give us the opportunity to differentiate, to make a choice between the farming and then bakery. So cost of investing in bakery is 25,000. Cost of investing in farming is 20,000. So the difference in cost of 5,000 becomes a differential cost. So we say differential cost is the cost that differ between two alternative activities or costs of action. For example, if alternative X will cost 200 extra, and alternative Y will cost 2,500, 250 extra, then the differential cost is the 550 cedis in favor of the alternative X. So that becomes the differential cost. Now, incremental cost is also another term that connotes relevant cost. An example of relevant cost is differential, incremental cost. What is incremental cost? Incremental cost is the additional cost. The word incremental tells you that it's an additional cost. So incremental cost is the additional cost incurred as a result of a decision. It can be described as an increase in cost from one alternative to another. So incremental cost is, for example, if we have a machine that we are using, which costs 100,000, and then we now think that we need to buy a new machine that will have a higher capacity, and we intend to, let's say, dispose of the old machine to acquire the new one, and then the cost that differs between these two is, let's say, the old one costs 100,000 and the new one will cost 120,000. Then the difference in cost, or the incremental cost, will be the 20,000. It is the additional cost that will be incurred as a result of a decision. Additional cost that will be incurred as a result of management decision, and can be described as an increase in cost from one alternative to another. Okay, so then future cost, of course, future cost is a cost that will be incurred in that is not yet incurred. The cost that is not yet incurred is a future cost, because if you have not incurred a cost yet and it will be incurred in years to come, that is a future cost. But you cannot define future cost as cost that will be incurred in the future. So don't define future cost as cost that will be incurred in the future. Just say future cost is a cost that has not yet been incurred, and it is a cost that will be incurred as a result of a decision. It's the cost that will be incurred as a result of management decision, right? So we can now talk of irrelevant costs. We have already learned that irrelevant costs are costs that may not arise or that may not change, that may not influence management decision. So we have learned about the relevant costs. We have seen that relevant costs are costs that change as a result of a decision. They are costs to be incurred in the future if a particular decision is taken. And what happens if costs have already been incurred? Costs which have already been incurred in the past are irrelevant costs and are referred to as sunk costs or past costs. This sunk cost is a cost that has already been incurred or has already been spent and cannot be avoided irrespective of whatever course of action a manager takes. So if a cost has already been incurred and will not change or will not be influenced by any decision management takes, such costs are irrelevant costs. For example, if you have rented a house and you have paid for the rent for the month, and then you decide to, let's say at the beginning and in the middle of the month, you decide to leave, you cannot say that the rent you are paying for that month, you are going to collect it. It's a sunk cost. It's a cost that has already been paid. You cannot change, you cannot correct, you will not be influenced by your decision. If you have taken taxi to the ACC station from Cape Coast to go to Accra, and the taxi driver has taken you to the STC station, you have paid him, maybe he charged you 100 Ghana cedis, so let's say 50 Ghana cedis, you have paid him, he's gone. Now, while at the STC station, you got a call at home that, or you got the call from your office that the trip to Accra is no more going to be relevant. Now, so if you change your decision to go to Accra at the STC station, what cost will be relevant? Is the taxi fare relevant? Again, are you with me? Hello?
Hello, sir.
Yes, so I'm saying that what cost will be relevant? Now, the taxi driver, you have paid him, he's gone. You are the STC station, you are told that the trip to Accra is no more going to come on. So you now change your decision to go to Accra. Which of the costs is going to be relevant? Which of the fares?
The fare to Accra.
The fare to Accra is going to be a relevant cost. Fine,
Yes.
because in that case, once you have decided to, so you can avoid incurring that cost. That cost becomes avoidable cost, so you are not going to incur it. But the taxi driver, is it a relevant cost? The taxi fare to the station, to the SC station, is it a relevant cost?
No, sir.
Why?
What you are saying, you can't walk to the station, so definitely you have to take a taxi.
No, listen, I'm talking of the taxi driver you took to the station there, and you have paid him and he's gone.
So
Not
it's
the one you are
irrelevant.
coming to. He said it's irrelevant. Why?
It's irrelevant.
It's irrelevant.
Take the question again. I'm saying that you have maybe you are working with a bank or something, then your head office at Accra has requested that you come to Accra. So maybe you are at Appleska or you are at somewhere. You took a taxi to the STC station and he charged you, let's say, 50 cedis. You have paid him when you got there and he's gone. Now, there at the STC station, you got a call that the trip to Accra is no more going to come on. Is that fare you pay the taxi driver to the station relevant or irrelevant?
Sir, it's irrelevant.
Why?
Irrelevant.
Why?
Because the trip did not come on.
Is what?
Because the trip did not come on, so it has become irrelevant costs.
And the money have gone wasted. The money
So
you paid.
you don't explain is we are saying that see that that one, the cost has been incurred. That cost has been incurred and it's sunk cost. You cannot change that cost you have incurred as a result of you not going to Accra. You cannot go and call the taxi driver that you no more went to Accra. So the money you gave him for bringing you there, you should give it to you. That is not possible. That means that cost is a sunk cost. It has already been incurred and cannot be changed as a result of the change in decision. Have you seen? That's how you explain it. Okay. It's not that you didn't go to Accra, but the fact that the decision that has changed after going to Accra is not affected by that taxi fare you pay. That is already a sunk cost, right? So also a cost which will be incurred irrespective of whether a decision is made or not is an irrelevant cost. We also have committed costs. Some costs you have not paid it yet. Not like the taxi driver, you have paid him and it's gone. But there's some costs you have already committed yourself. And so whether you decide to go ahead with it or not, it will not be changed by that decision. Okay. So such costs cannot be avoided no matter the decision, and it is not relevant for decision making. So in making decisions, irrelevant costs that cannot affect the decision can be simply put as past costs and unavoidable costs. We call some of them committed costs and sunk costs. Right. So example of sunk costs are non-current asset already purchased and fixed costs already paid out. Example of unavoidable costs are wages of employees who are redundant. You have already employed them, and so whether they get the work to do or they not get work to do, you have to pay them. So it becomes a committed cost. And also, so there we are talking an example of employee unavoidable costs are wages of employees who are redundant and are on the payroll already, who can be used for a new project. Whether you use them for the new project or you don't use them for the new project, you will still pay them. Okay, so that is it. So that is irrelevant cost. Then example, we have a few question that what is the relevant cost? Be able to explain what a relevant cost is for theory purposes. Define the relevant costs, or define the following concepts that relate to relevant costs: avoidable costs, unavoidable costs, incremental costs, opportunity costs. Distinguish between sunk costs and future costs. Right. So let's move on to the next session, session 2. Session 2 is about the relevant cost of material and labor. Remember that the element of costs are material, labor, expenses, and indirect expenses. Normally, the expenses, indirect expenses, or indirect costs are put together to call overheads. So the element of costs are material, labor, and overheads mostly. Okay. So in determining the relevant costs for decision making, you should be able to know what material costs are relevant, what labor costs are relevant, what overhead costs are relevant, and all that. What machine costs are relevant because we use the machine too. So machine costs, what machine costs are relevant. These are very important things we are going to do in this session. So let's look at, by the time we finish discussing this session, you should be able to identify the relevant and irrelevant costs of material. You should be able to identify relevant machinery costs, and also prepare a statement of relevant material and machinery costs. So relevant material costs. So what material costs are relevant? There are few steps or few concepts you must put in place, or few conditions that you must understand to be able to determine which material costs are relevant. We saw in cost accounting, and you did that one in cost and management accounting, that material cost is one of the 3 elements of cost. So in cost and management accounting 1, we talked about the element of cost. And so we were told that one of the element of costs is material. Therefore, in computing the cost of a product or service, you need to compute the material cost and add it to labor and expenses to arrive at your total cost. You know how to get the total cost of an item produced. So before we get the total cost of an item produced, we must of necessity determine the material cost, labor cost, and then overheads. Right. So when considering the relevant cost of material for decision making, there are certain conditions or certain considerations you have to take note of. And these are, so take note of these conditions or these considerations that will help you identify what material costs are relevant and what material costs are not. So first of all, we're saying that estimated purchase price would be the relevant material cost if the material is not in stock. By way of explanation, we are saying that when we want to produce a particular item and the material, we don't have the material in stock, the relevant cost of the material we use for that particular decision or project will be the purchase price of the material. So that because once we do not have the material in stock and we are going to use them for a particular decision, that cost of the material we are going to buy becomes the relevant cost. And therefore, we are saying that the estimated purchase price of the material becomes the relevant cost. Because once we take a decision, we have to make an estimate of the material we need to produce that particular item. Therefore, that estimated purchase price becomes the relevant cost. Okay, if the material is not in stock. Now, if the material is already in stock and will be replaced if used for a particular activity or a particular decision, then the relevant cost is the replacement cost of the that material. So if we have the material already in stock and we use the material regularly for production and we'll replace them when we use it, then the relevant cost of that material is the replacement cost, not the purchase price, because the material might have been purchased already. So if we use it and we have to replace, the relevant cost of the material for the new product is the replacement cost. Then go ahead, next one. If the material is already in stock and has no further use, look at the condition. If the material is already in stock and it has no further use, apart from it being used on a particular activity, then the relevant cost of that material is the realizable value of the material, if any. So if you have the material in stock already, but it is not in use or has no other use apart from it being used for a particular decision, then the relevant cost to this particular product is the realizable value, because if we don't use it, the only thing is that we have to go and sell it for something. So the relevant cost to the management becomes the realizable value. Now, if it should also be noted that if the material has no realizable value, then the relevant cost is 0. Even if we use it for the particular decision, the relevant cost is 0 because the material has no realizable value. Okay, so 4 things, 4 conditions or 4 considerations. First, if the material is not in stock and we have to purchase it purposely for a particular decision, then the relevant cost is the estimated purchase price. If the material is already in stock and are used regularly and will be replaced when used, then relevant cost is the replacement cost of the material. If the material is already in stock but has no other use apart from it being used for a particular activity, then the relevant cost to that particular activity is the realizable value, if any. If there's no realizable value for that particular material, then the relevant cost is 0. Please, are you with me? Did you understand what I said? Hello?
Yes, sir.
Yes, sir. We are here.
Are you there?
Yes, sir.
Yes, please.
Okay. So do you have any question to this one? So the conditions I mentioned are just 4. The first one is ask yourself if the material is in stock. If the material is not in stock, you have to go and buy it purposely for a particular decision or a particular item. Then the estimated purchase price becomes the relevant cost. But if the material is in stock but used regularly and will be replaced when used, the relevant cost is the replacement cost. If the material is already in stock and has no other use apart from it being used for a particular decision or a particular activity, then the relevant cost is the realizable value of that material, if any. If there is no realizable value for that material, then the material relevant cost is 0. That is it. So let us look at small question here. Some of them will just jump it and then we'll go. So we say that Kojomo Konimo Limited has got an order to supply a product called Pato to Co Insia Limited. To make the product Pato, the following materials and cost data are available. We have material M2, which will have to be purchased specially for the order, and it costs 250. Material M3 is already in stock. It was purchased at 100 Ghana cedis and has no other use, but could be sold for 45. Material M is already in stock and used regularly in the company. It was purchased at 100 cedis, 300 cedis, and if used for the order, will have to be replaced at 350. Compute the relevant cost of the material. So let's take the material M2. Material M2. What is the relevant cost of material M2? Based on the condition or the consideration we have given. The considerations are that if the material is not in stock and has to be purchased specially for a particular decision, the estimated purchase price is the relevant cost. If the material is already in use, in store, if we have the material already in stock and it is used regularly and will have to be replaced when used, then relevant cost becomes the replacement cost. If the material is in stock and it has no other use, it has no further use, but apart from being used for the new decision or new project, then the relevant cost is the realizable value, if any. If there's no realizable value for that particular material, the relevant cost is nil. That is the concept. So with this concept, what will be the relevant cost of material M2? Material M2, we say that which will have to be purchased specially for the order, cost 250. Material M is also already in stock. It was purchased at 100 and has no further use, but could be sold for 45. Material M4 is already in stock and used regularly in company. It was purchased at 300 and if used for the order, will have to be replaced at 350. Compute the relevant cost. So let's first of all look at material M2. What is the relevant cost? You are quiet. I've explained enough. Hello, are you there?
We are here.
Yes. So what is the relevant cost of material M2? You can see. Let me widen it. You can see. You can read.
Yeah. Material 2 is 250 Ghana cedis.
250 cedis.
Because it will be, so it's 250 because it's a relevant cost and it will be needed for the work, for the production of the pato.
Okay. So what it means is that this material is not in stock. This material is not in stock, and we have to purchase it especially for this project. Therefore, it becomes a relevant cost. Then that is the relevant cost is the purchase price. The purchase price becomes the relevant cost, and that is true. Right. Material M. What will be the relevant cost of material M to the product pato?
Say M saying.
What will be the relevant cost of material M3 for the product pato?
I think it will be a realizable value.
So what is it? What is it? Just tell me the amount.
It's 45.
45. Yes, because that material is already in stock. It has no further use. And so once it has no further use, its relevant cost is the realizable value, which is how much it can be sold for. Good. What of material M4? What is the relevant cost?
So it's 350.
That is the replacement cost. It is a replacement cost because this material is in stock. It's in stock and it is used regularly. When used for pato, it has to be replaced. So the purchase price, the relevant cost will not be the purchase cost, but rather the replacement cost, which is what? 350. Good. So that is how you do it. See, this is how you do it. Now go ahead, look at the example 1.2, where we have material X, Y, Z already in stock, required for the job, the purchase price, and then realizable value per unit, and then replacement cost. And then determine the cost of Y is in regular use. Y is in regular, so you can easily understand that one. Then we come to another one. So this one's let's look at the relevant cost of machinery. Relevant cost of machinery. Now, for relevant cost of machinery, what you have to note is that the historical cost of the machinery is a sunk cost. If the cost of buying the machine, the cost we paid or we incurred in purchasing the machine, which is the historical cost, is already a sunk cost. It's a sunk cost, and therefore not relevant for decision making. If we have bought you have bought a car already, you have paid for it, and you are now using the car, and there's a decision to do something about the car, that cost of the car is a sunk cost. So that is irrelevant. Also, depreciation is not a relevant cost. Somebody's mic is disturbing. The person should check. So depreciation is not a relevant cost. However, the incremental cost of using the machine is a relevant cost. So that is the idea, the concept, that the historical cost of the machine is irrelevant cost. The depreciation charge on the machine is also irrelevant cost. What is depreciation? Depreciation is simply the spreading of the depreciable amount of the asset over its useful life. So that will not be relevant to a particular product. Now, the relevant cost of a machine to a particular product is incremental cost of using the machine. And this includes the hiring charges. Here, the hiring charges, we are referring to the amount you pay for going to hire a machine. You haven't bought the machine, but you have gone to hire the machine specifically for a particular product. For example, in producing pato, if we go and hire a machine for a period and we pay that hiring charges, then it becomes a relevant cost because we have gone for that machine specifically for that particular product, and therefore the hiring charges becomes a relevant cost to that particular product. Then also the fall in sale value through use. The fall in sale value through use. For example, if before you start producing a particular product or a particular decision, an asset or a machine has a value of, let's say, entry value of say 100,000, and after using the machine for this particular decision, the value now becomes 60,000. Then the difference, the loss in value as a result of use, okay, is 40,000, and this 40,000 becomes the relevant cost for this product. So it is not the historical cost, but the loss in value or the fall in value or the fall in resale value of the asset as a result of use. Then extra repairs that would be incurred through use. Extra repairs. The extra repairs here, we are talking of the any other cost we incur in putting the asset in a position that will make it useful for producing, for undertaking that particular decision, is the extra repairs. It is not the normal maintenance. Normal maintenance cost is not a relevant cost, but the additional cost you are going to incur to bring the asset to a condition where it will be useful for the decision is what you call the extra repair cost. Okay, so these are the three main areas. Note that the historical cost of the asset is irrelevant. The depreciation charge on this asset is relevant. But if the asset is high, specifically for a particular product, then the hiring charges is important, is relevant. However, you must differentiate between this hiring we are talking about and then high purchase hiring. If you hire a machine on high purchase charges are not the rental charges. It's different thing. Okay, so take note. So let's look at example 3.2, and this says that determine the relevant cost of the following machinery for a contract work to be executed this year. And the contract that we have a special machine that will be needed for the contract cost. I think it's 1,000. Cost 1,000 cedis. Okay, 2 years ago, and has been depreciated on straight line basis at the rate of 25%. The machine can be sold for 600 now, or in a year's time for 150. So it can be sold now when we are coming to use it for a particular decision, or be sold in a year's time after the production at 150. The B says that another machinery required for the contract has been purchased already on high purchase terms. It has been purchased already on high purchase terms, and the cash price of the machine is 2,100, which 2,100, which was purchased 3 years ago and has been depreciated on straight line basis at the rate of 20%. The monthly high purchase payment, take note, this one is a monthly high purchase payment for the machinery is 35 cedis, and this machinery would be used for this contract for 10 years, 10 months. It is estimated that the machinery will lose 320. It is estimated that the machine will lose 320 in sale value if it is used for the contract. And then the last one is an equipment which costs 1,500 for 4 years ago is currently idle or lying idle and can be used on the contract. The equipment could be sold now for 600 or at the end of the contract for 250. What are you are required to compute the relevant cost of machinery for the contract. So let's look at the first one. A machine that will be needed for the contract that cost 1,000 Ghana cedis 2 years ago and has been depreciated on straight line basis at the rate of 25%. The machine now can be sold for 600 now, and in a year's time for 150. What is the relevant cost for the machine A based on the concept we have learned that the historical cost of the machine is irrelevant, the depreciation is irrelevant, but the incremental cost of using the machine is what is relevant. And the incremental cost of using the machine can be the hiring charges or the fall in resale value, the fall in sale value as a result of use, and other incremental repairs. So what is the relevant cost of the machine A? Are you with me?
Yes, sir. It's
Yes,
450.
It's 450. Good. How did you get that?
And sir, because the machine is the loss in sales, the value is 600, then we take away the 150 from it. We'll get the 450.
Okay, so it means that the machine, what it means that the purchase price or the cost of the machine, which is 1,000 cedis that was bought 2 years ago, can never be relevant, okay, because it's a historical cost. Depreciation of this 10,000 that is spread 4 years is also irrelevant. But when the machine is used for this contract or this contract, the machine now can be sold for 600. Now, after a year's time, when we have used it for this contract, it can be sold for 150. Therefore, the fall in value of the fall in the resale value of the asset will be 600 minus 150, and that will be 450. Very good. What will be the relevant cost of the machinery B? What will be the relevant cost of machinery B for this contract? And here we are told that this machine has been purchased on high purchase 3 years ago. The purchase price is 2,100. The monthly high purchase payment is 35, and the machine is depreciated at 20 cedis per 20%. Okay, but it is estimated that the machinery will lose 320 in sale value if it is used for this contract. What is the relevant cost? Hello.
So the loose value is 320.
So how are you
320.
explaining it? How would you why are you choosing the 320?
So per the question, it said that it is estimated that the machinery would lose 320 in sale value if it is used for the contract work. So that's the loss.
So that's very good. So it means that the loss in value as a result of use, which will be 320, okay, is going to be the relevant cost. Because if you look at the question, the purchase price of 2,100 and then the high purchase of 35, and it's all those ones are irrelevant. What is relevant is that when this asset or this machine is used for this contract, what will be the loss in value of the asset? What will be the loss in the resale value of the asset? The loss in the resale value of the asset is 320, and that is what is going to be relevant cost to this particular contract. Okay, now let's look at machinery C. Machinery C, what will be the relevant cost? Machine C, the question says that this equipment cost 1,500 for 4 years ago, and currently it is lying idle and it can be used on this contract. That equipment can be sold now for 600 or at the end of the contract for 250. So what is the relevant cost of this equipment to the product, to the contract? Hello, are you with me? Some of you are sleeping.
So we are
So
here.
350.
What is it?
Thinking.
You are
350.
thinking. But it's like only one person is talking. Yes?
350.
350.
350.
Yes, sir.
Yeah.
Well, okay. How did you get a 350?
The equipment could be sold for, could be sold now for 600, and at the end of the contract, sold for 200, 250. So when you subtract
Very
the
good.
2 from the 600,
So the fall in the resale value of the asset will be 350. Good. So that's how it is. So see how the analysis are done. See how the analysis are done. Okay, so you can look at the self-assessment question and then go through the any of these self-assessment questions can be picked for you. So try to study it carefully so that you can be able to determine the cost of material, the relevant cost of material, and relevant cost of labor. Let us go through unit session 3, and then if we cannot continue, we can call it off, because it's like you are leaving. You started, you were about 10, now you have only left with 5, and it's not good for this to happen. I don't know why you are leaving, because the network is not disturbing. The network is on. So I don't see why you came and then you left like that. Okay. So be careful. These things, you are not learning for examination, you are learning to transform your ability. So you must understand the things you are doing. That's why I'm taking my time to take you through the book, not just a PowerPoint. I'm taking you through the book so that you understand the issues very well. So if you don't come for lectures, or you come and you leave like this, it is very bad. All right. So let's go through unit 3. Now we are going to talk about the relevant cost of labor and overheads. Relevant cost of labor and overheads. Remember that the element of cost are material, labor, and expenses, which are normally put in, and then machine cost can also be a part of the cost. So take note. So once we have looked at the relevant cost of material, you must also look at the relevant cost of labor, so that when you are taking decisions, you can be able to differentiate clearly what costs are relevant and what costs are irrelevant. So by the time we finish going through this section, the session 3 of unit 3, we should be able to distinguish between relevant labor costs and irrelevant labor costs. We should be able to identify relevant overhead costs and irrelevant overhead costs. We should be able to prepare a statement of relevant labor and overheads. So just as we went through with material and machine, we also have to consider some few points or factors to see whether labor cost is relevant or irrelevant. Now, here we said when you are determining relevant costs for decision making, you need to consider that the variable cost of labor is relevant. And when we talk of variable cost of labor, we are talking about additional cost of labor that you will employ for undertaking for taking a particular decision or for undertaking a particular project. Okay, if the labor is not available and you are going to employ them for a particular decision, then that cost of labor is the variable cost of labor and it is relevant. Also note that the loss contribution, if labor is diverted from its current use, is relevant. And by lost contribution, we are saying that if labor have already been employed by the organization and they are already on the payroll of the company or on the organization, you are paying them. If you take a decision to do something or to produce a particular product, and the labor who are already working are going to be diverted from the work they are doing to the new product, then the relevant cost is the contribution that you lose when you divert them. Contribution from that particular project or work they are doing that you will lose if you divert them from the work they are doing. It means that when employees have already been employed, their current pay is not relevant, because whether you decide to use them for new project or not, you will still pay them. So that is irrelevant. What is relevant is the loss contribution when you divert them from the current work they are doing. I hope you understand that. Please, are you with me?
Yes,
so
sir.
now let's look at some example here. Copa Limited has received an order to supply a special component that will require 2,250 hours of skilled labor at 3 cedis per 3.5 cedis per hour, and 3,000 hours of unskilled labor at 2 cedis per hour to Anansi Limited. The skilled labor is in short supply, and Copa Limited would have to employ skilled labor to manufacture the components. The skilled labor will have to be diverted from other work, which is expected to earn a contribution of 3 cedis per hour, compete the relevant labor cost. So let's look at the skilled labor. What would be the relevant costs? What would be the relevant cost?
225 multiplied by the 3.5.
Why? Why are you saying so?
I'm saying that because to get this one, the actual amount to be paid to those who are skilled, you need to multiply the amount per hours by the hours they worked.
Yeah, so the reason why we are using that amount is that the skilled labor is in short supply. So it becomes what we are going to hire is a variable labor cost. So we are saying that the variable labor cost of labor is relevant. So once they are in short supply and we are going to now employ those hours, the rate per hour we are paying them is what we have to multiply to get the labor cost for the skilled labor. What of the unskilled labor? What will be the relevant cost? What will be the
for the unskilled labor? We are supposed to multiply the 3,000 hours by the we are multiplying by the 3.
Why?
By the 3, because they said that the unskilled labor will have to be diverted from other work, which is expected to earn a contribution of 3 cedis per hour. Because we are diverting them. So they
very
are
good.
doing
Very good. So because the concept you are learning is that for labor, the loss contribution, if the labor is diverted, is what is relevant. Okay, so this unskilled labor are already employed. We are paying them to 2 cedis per hour, but that is not going to be relevant because whether we use them or we don't use them, that 2 cedis will be paid them. But if we now use them for this new work, it means that they have to stop what they are doing somewhere, and for that work they are doing, we are making a contribution of 3 cedis on them. So if we divert them, our loss contribution will be 3 cedis by the number of hours. Okay, so that becomes the relevant cost of the unskilled labor becomes 3,000 times the 3 Ghana cedis, which is the loss contribution per hour. Do you understand that? Do you all understand?
Yes, sir.
So now this thing becomes this one. So the loss contribution is this. Now let's look at the relevant cost of overheads. Relevant cost of overheads. What you have to know is that generally, variable overhead costs, which are avoidable, is a relevant cost. Variable overhead costs that are avoidable, once it's variable overheads, once you can avoid it, it's variable cost. And therefore, if you do not do something, you will be able to eliminate it. Then and most of the variable overheads are avoidable. So generally, the concept is that generally variable overheads which are avoidable is a relevant cost, and fixed overheads which relate to existing fixed facilities and are therefore unavoidable is irrelevant cost. So variable overheads that are avoidable are relevant costs, but fixed overheads that relate to fixed facility and are unavoidable is irrelevant. It means that if fixed cost is avoidable, it is relevant. So note that for overheads, if the overhead cost is avoidable, it means that it is relevant cost, be it variable cost or fixed cost. Once it is avoidable, it can be eliminated by a particular decision, then it is relevant. Okay, but when the fixed cost can the cost cannot be avoidable, cannot be eliminated, or it's unavoidable, no matter what decision management take, then that overhead cost is irrelevant. But most variable costs are relevant because they are costs to be incurred and can be avoided when management decides not to do something. Right. So with that in mind, let's also look at these few questions so that we can look at it. Africo Limited has received an order to make a special component for Paju Limited. To make these components, 3 new workers will have to be taken at the cost of 3 cedis per hour per worker. 3 cedis per hour per worker for 300 hours. That 3 new employees are supposed to be employed at 3 cedis per hour per worker for 300 hours. Now, B says an employee earning 3,600. Let me just, they didn't use the comments well. 3,600. Oh, look at where it is. Okay. That an employee earning 3,600 per annum will be made redundant, but receive redundancy fee of 600 Ghana cedis. A highly skilled labor paid 5 cedis per hour will have to be transferred from another work, and the loss contribution is 6 cedis per hour for 200 hours. Variable and fixed overheads are absorbed at the rate of 6 cedis. Variable and fixed overheads are absorbed at the rate of 6 cedis per skilled labor hour as follows. So we have the fixed overheads and then the variable overheads. Fixed overhead is 3 cedis 50 pesos, and then variable overhead is 2 cedis 50 pesos, giving you 6 cedis. Okay, you are required to determine the relevant costs in each case and compute the relevant costs if the component is to be made. So let us look at the first cost. That one has to do with the labor cost. So 3 new employees will have to be taken at the cost of 3 cedis per hour for per hour per worker for 300 hours. So what will be the relevant costs of the labor for the first one? How do you get that?
So 3 cities multiplied by 100.
3 cedis multiplied by 300. Are you sure?
Okay.
Yes.
Yes.
So the workers are 3. So the 3 workers, and then the cost per hour, and then you multiply it by the total.
So it's going to be 3 times 3 times 300. Is that it?
Yes, sir. And that will be 2,700.
That's good. Okay, now let's look at the B1. An employee earning 3,600 per annum will be made redundant, but receive redundancy pay of 600. What will be the relevant cost?
600.
Very good, because he's already
Redundant.
he's been redundant. So he has to be laid off, and he's going to be receive a redundancy fee. So the redundancy fee, that is important here. Okay, now a highly skilled labor paid 5 cedis per hour will have to be transferred from another work, and the lowest contribution is 6 cedis per hour for 200 hours. What will be the relevant cost?
Lost contribution.
So the lost contribution, that is 6 times the 200.
200.
Very good. What's your name? The lady you are. What's your name?
Gifty.
Is that
Fiba? No, a Fiba.
Fiba. But is Gifty there or is gone?
Gifty is on it.
Say, I'm here.
Gifty, I have not been hearing from you. You have been contributing.
Yes.
It's been a long time. All right.
We are left with 5.
Come again.
So I said we are left with 5.
5 stars.
Okay, yes, you are left. You are going like that. Well, we'll finish this session and we go. But those leaving, leave them. The examination will just catch up with them. All right. So now for the skilled labor, for the overheads, fixed overhead, unless the question tells you that the fixed overhead is avoidable. If the question does not tell you the fixed overhead is avoidable, assume that that is irrelevant. Okay? Because for fixed overhead, generally, when they relate to fixed facility and they are unavoidable, they are irrelevant. So if the question tells you that the fixed overhead is avoidable, that is where you come back. For variable overhead, generally, variable overheads are relevant because they are avoidable. Okay, so if the question does not tell you that the variable overhead is unavoidable, assume that it's avoidable. So it is relevant. So in this case, with the overheads, the only variable aspect is going to be the 2.5, then multiplied by the skilled labor hours, which is because you are told that the variable and fixed overhead are absorbed at the rate of 6 cedis per skilled labor hours, and the skilled labor hours here is 200 here. So to get the variable, hello.
Yes, sir.
Yes, so we are here.
Yeah, to get the variable overheads, or to get the overheads, you are only going to take the variable overhead as the relevant overhead cost. So that is what we have here. So you have the relevant cost of labor, the redundancy pay, and then the loss contribution, and then that of the relevant overheads. The fixed costs are irrelevant. So the total cost will be this.
Irrelevant.
All right. All right. So we are done with unit 3. We are left with unit 3 more units to finish session 3. And Saturday, we'll be vigilating at Tamale. So I would love to talk to Kukuya because they are doing online, what do you call it? Online quiz. The online quiz. And online quiz, I think there's some directions that you have to be given to students. You have been doing it, so you know how you do it.
Yes, sir.
But for the undergraduates, for the code undergraduate students, they are now going to test it. So vigilating them will be somehow this thing. But whatever it is, our period is from 7 to 11. Okay. So I'll go with my computer, and if there's chance, I'll connect and we will start. But I had wanted, if you have all, I had wanted us to meet you Friday evening when I get to Tamale. Meet you. We do the 3 hours. We do the 3 units. The 3 units left. Just the 3 units. We can finish within the 2 hours.
That's a great session.
So that Saturday we now know that we have the 3 other units to go. So if it is possible, I will want to meet you on Friday evening.
So we will communicate with our colleagues.
Okay. We'll communicate with them so that Friday evening we'll finish with the 3 sessions left. We are left with in the unit 3, so that we then move on to unit 4 when we start on Saturday. So that at least we'll be able to catch up and finish. If even there's any meeting again after you have finished the normal meetings, it will not be much. Okay. So that is the information for you. So connect them. Is Emmanuel here?
So I'm here.
Good. So put on your platform. Let us discuss. So Friday, when we get there early, latest by 7 o'clock, we can start and finish by 9. Okay.
Okay.
Yes.
So by Saturday is around you. We meet around 11:52. I think 4 o'clock.
Oh, okay. Saturday is not going to be in the morning again.
Yeah, it's not going to be in the morning.
Oh, that's very good for me. That's very good. So in the morning, I will be able to monitor things. By that time, we can just start. That's okay. Then don't worry. Provided I'm only looking at the network. Sometimes network, when you are away like this, network steps. So don't worry, then that's fine. So Friday, let us meet and clear the units left, 3 sessions left, so that we can start on Saturday. Okay. Thank you for your time.
Yes, sir.
Those
Thank you.
who are sleeping, they should be careful. All right.
So there is the taking practice.
Thank you.
Taking.
It seems like the thing is bulky, plenty. And,
it was breaking, eh?
there's like
No.
The concept and the aspect of the cost management account too is very bulky.
Okay.
And some are also tired. The teaching practice, some of the schools are using us too much.
You are doing the teaching practice.
Yes, sir.
Yes, sir.
Oh, okay. But tell them you are still in school. Because for you are still in school. You do your thing online, so they can't be using you like that.
They will not listen. No.
They are not listening.
They will not listen to you.
But
Even
many
if you
of you are
don't have-
teachers. Many of you are teachers already. Is that not it?
Yeah, we are teachers in the basic.
Yes, we are all teachers.
Okay, you are teachers in the basic school, but this time you have to go to the secondary schools.
Yes.
Yes.
Okay. All right. No, don't worry, shall be well.
It is well.
Okay.
Thank you very much.
So, thank you. All the best.
Thank you very much.
You're welcome.